Hi, I'm Mike and thanks for watching the video. I'm going to talk about short sales today. As you may already heard, short sales is a buzzword. It's a very common word. And so what is a short sale? Well, basically what a short sale is, for those of you that don't know about it, a short sale is if a homeowner is trying to sell a house and his value of the home is less than what he owes on the bank. So when he tries to sell the house, he's going to be running short. Let me give you a quick example. If somebody bought a house for $600,000 and he owes, let's say, $550,000 on the house, and he wants to sell it, but the value of the house is now $450,000, so he's going to be short almost $150,000. So when you sell the house, we have to negotiate with the bank for the lender to let go of that and give sort of like a credit to the seller. So that's in a nutshell what a short sale is. And as I mentioned earlier, there's a lot of people getting short when they're trying to sell the home. So one of the requirements for the lenders to do a short sale when you sell a house is hardship. Actually, there's three requirements. One of the most common one is that the seller must have some kind of hardship. What's a hardship? Mainly we're looking at a financial hardship. Either there's a loss of a job or death in the family, so the income's down, or some emotional or medical problems. So there must be some kind of hardship, physical or financial, for them to consider. The second thing the bank will consider for you for a short sale is you have to be not making enough money to make the payments. So let's say your total expense, monthly expense, cars and homes and food and gas, your basic expense is $10,000, but because of a loss of a job or part-time job or whatever, you're only making $7,000, $8,000 a month. So you're technically short almost $2,000 a month. So that has to be a requirement where you're running short on your daily living. The second thing, and also very important, actually the third thing, which is also very important, is that you have to be insolvent. That means when you sell the house, when a seller sells a home short, they should not come up with any money to the seller. So they should not be getting any money when they sell the home. That's one of the requirements. So the three requirements for a bank or a lender to do a short sale is you must have financial hardship, you must be short on your income, and you must be insolvent when you sell the house. No cash back allowed to the seller. So those are the three things to do a short sale in very nutshell. Of course, to get more information, more details, contact your lawyer, your attorney, your accountant, or feel free to call me and I'll refer you to some nice sources, reliable sources. As I'm talking about short sales, I just want to also mention, the reason I wanted to mention short sales is because the last 2 or 3 years we've seen a lot of short sales, distress sales, foreclosure properties. And my feeling is, and this is based on going to a lot of seminars, going to a lot of webinars, talking to buyers and sellers every day, talking to a lot of agents who deal with these properties every day, my opinion is that we have another 2 or 3 years where we are going to get short sales and distressed properties. And I'll give you one scenario, one quick example why I feel that more short sales are coming down the road. And putting it up to date, I'm going to say from 2010 to 2012, we have a whole bunch of them coming. What we've seen the last few years is what we call is the first wave of distressed properties that has come to the market. These are the ones that were bought in 2006, 2007 with subprime loans, with Alt-A loans, where people got loans with 1%, no qualification, and what happened was the interest rate jumped on them and they could not afford the payments, especially with a lot of job loss. So that was the first wave. And what all these gurus are saying, and the people who study economics and finance and all that, so putting it all together, they're saying there's a second wave of foreclosures coming. It's hitting as of right now. This is almost December 2009. Where is the second wave of foreclosures coming? Well, one quick example, there's a lot of other reasons, but one quick example, for people who bought homes in 2002, 3, 4, 5, and 6, a lot of them bought with loans that are adjustable in 3 years, adjustable rate in 5 years and 7 years, adjustable rate, and then it will become fixed. So all those rates are adjusting. So in other words, if I bought a house in 2002 with a 7-year loan, it's adjusting right now. And if I got a rate of 3% or 4% at that time, it may adjust to 6 or 7 or 8%. In other words, my payment's going to go double. So one of the reasons is that's what's going to happen because people can't afford the payments. And hopefully he hasn't lost a job or has a cut in pay or wife didn't lose a job. So here's a simple reason why there's more foreclosure waves coming. So if you know somebody or friends, family, peers that needs help with loan modification or short sales help, have them call their attorney, their accountants, their agents, or they can always go to my website, shortsaleshub.com or mikepatel.com, and there's a lot of resources for you to pick away. Appreciate you looking at this video, my business is helping you. Thank you.